This single polymarket trade made me over $20,000, and almost nobody noticed it while it was happening. No viral headline, no crazy breaking news, no influencers screaming about it. It was a slow, boring political market called Venezuela Leader End of 2026, and that's exactly why it worked. Because when markets are boring, they're usually inefficient. When I first pulled it up, Delcy Rodriguez was trading around 67%, Nicolas Maduro around 11%, and the narrative floating around was that transition pressure was building inside the regime. On the surface, it looked reasonable. The crowd was pricing in change. But pricing something in doesn't mean it's statistically correct. So instead of guessing, I ran the market through Polysight's AI analyzer. And what it flagged immediately wasn't sentiment, it was structure. No confirmed electoral transition aligned to 2026. No credible institutional break. Historical data on regime durability strongly favoring continuity in similar centralized systems. The AI gave over 60% confidence that Maduro's continuity scenario was underpriced relative to base rates. That was the moment the trade went from interesting to edge. Because this wasn't about predicting a coup. It was about asking, is 11% too low given structural probability? Most traders don't think that way. They look at headlines. They look at Twitter. They react. Systems don't react. They compare implied odds to structural likelihood. And that gap is where money lives. So I started building the position slowly, not all at once. That's another mistake beginners make. They slam market orders and move the price against themselves. I scaled in while liquidity was stable, keeping my average entry clean. At that moment, the trade didn't look sexy. No green candles exploding, no hype. In fact, for the first few days, nothing happened. And that's where most people lose discipline. Flat markets make traders impatient. But I wasn't trading excitement. I was trading expected value. Over the next couple of weeks, small cracks started forming in the narrative. Political stability reports reaffirmed regime durability. No confirmed succession mechanics emerged. The structural thesis held. And slowly, very slowly, the market began correcting. Delcy's implied probability cooled off. Maduro's odds ticked upward. And here's what most people don't understand about prediction markets. You don't need to be right about the final outcome to make money. You just need the price to move toward fair value. That's it. As the correction started, the position began compounding. Small percentage shifts on size turn into real numbers fast. 5%, 8%, 10%. At one point, I was staring at a $12,000 unrealized gain. That's when psychology kicks in. Do you take profit? Do you hold? Is this the peak? This is where emotion destroys edge. So I went back to the thesis. I reran the market through Polysight. I checked whether structural probability had actually changed. It hadn't. The AI still showed durability outweighing transition narratives. So I held.
Volatility hit. A short burst of political chatter pushed the market briefly against the position. I watched thousands of dollars in unrealized gains compress in hours. This is the moment where gamblers panic. But nothing structurally changed. No institutional trigger. No credible timeline shift. Just noise. And when you understand that markets overreact to noise, you stop fearing volatility. You expect it. So I held through it. And as quickly as the spike came, it faded. Liquidity normalized. Implied probabilities recalibrated. And that's when the real move happened. The market gradually aligned closer to structural expectations, and the position expanded beyond $20,000 in profit. Not because I predicted the future, not because I knew something secret, but because the implied odds were wrong, and time allowed that inefficiency to close. Here's the deeper lesson. Most people approach polymarket like it's sports betting. They think in outcomes. Will this happen or not? Professionals think in mispricing. Is this probability accurate? Those are completely different games. The crowd trades stories. Systems trade base rates. And Polysight helped quantify something most traders ignore: regime durability models. transition probability distributions, and narrative overpricing relative to structural stability. It didn't magically print money. It simply forced me to think in probabilities instead of opinions. And that's the edge. This trade wasn't flashy. It wasn't viral. It was disciplined. It was patient. And it was built on identifying a gap between implied odds and structural likelihood before the crowd corrected it. That's how one quiet political market turned into over $20,000. And if you're watching this thinking it was just luck, ask yourself something simple. When you open Polymarket, are you reacting to headlines or are you measuring probability? Because that difference is the line between gambling and trading.